What if I told you that choosing the wrong home equity loan could cost you tens of thousands of dollars over the life of your loan? Today, I'm going to show you the differences between a HELOC, a home equity loan, and a cash-out refinance. These are three of the most misunderstood mortgage products, and choosing the wrong one can cost you money. By the end of this video, you'll know exactly which option makes the most sense for your situation. Hi everyone, I'm Brian Jahanban, a mortgage broker with over 20 years of experience helping homeowners refinance, purchase homes, and use their home equity to achieve their financial goals. Let's dive in. Before we compare these loan options, let's talk about what home equity actually is. Home equity is simply the difference between what your home is worth and what you owe on your mortgage. Here's a simple example. Imagine your home is worth $900,000. Your mortgage balance is $500,000. That means you have approximately $400,000 in equity. Think of your home equity like money you've built over time. It isn't cash sitting in your bank account, but there are financing options that may allow you to access a portion of it. People use their equity for many different reasons, including remodeling their home, consolidating high-interest debt, purchasing investment properties, paying for college, starting a business, or creating an emergency fund. Now let's compare the three most common ways to access your home's equity. Let's start with the HELOC. HELOC stands for Home Equity Line of Credit. The easiest way to think about a HELOC is as a credit card secured by your home. Instead of receiving one lump sum, the lender approves you for a credit line. Maybe it's $100,000, $200,000, or even more, depending on your home's equity. The biggest advantage? You only borrow what you actually need. Let's say you're approved for a $150,000 HELOC. If you only use $40,000, you generally pay interest only on that amount, not the entire credit line. Many HELOCs also let you borrow, repay, and borrow again during the draw period. That's why contractors, investors, and homeowners doing phased remodeling projects often like HELOCs. But there's something you need to know. Most HELOCs have variable interest rates. That means if market rates go up, your monthly payment can increase. If you're comfortable with some payment flexibility and want ongoing access to funds, a HELOC may be a good fit. Now let's talk about a home equity loan. This works differently. Instead of giving you a line of credit, the lender gives you one lump sum. For example, you borrow $150,000. That money is deposited into your account. Then you begin making monthly payments. Most home equity loans have fixed interest rates, fixed monthly payments, and fixed loan terms. This makes budgeting much easier because your payment doesn't change. A home equity loan can be a good option if you know exactly how much money you need for a major expense, such as a large home renovation, debt consolidation, college tuition, or purchasing another property. One thing to remember is that interest generally starts accruing on the full loan amount once it's funded, even if you don't spend all of the money right away. Now let's talk about the cash-out refinance. This is where many homeowners get confused. A cash-out refinance doesn't create a second loan. Instead, it replaces your existing mortgage with a new mortgage. Here's an example. Let's say your home is worth $1 million and you owe $450,000. You refinance into a new loan for $650,000. The first $450,000 pays off your existing mortgage. The remaining $200,000 is paid to you at closing. Simple. Now here's the biggest question I hear every day. Brian, I have a 3% mortgage. Why would I refinance? That is a truly great question, and I hear it every day. Let's explore exactly why that is. In many cases, it may make sense to keep that low-rate first mortgage and consider a HELOC or home equity loan instead. However, there are situations where a cash-out refinance can still make financial sense. For example, if you're carrying high-interest credit card balances, personal loans, or other expensive debt, replacing multiple payments with one mortgage payment may improve your monthly cash flow. Every situation is different, and the right answer depends on your current mortgage, today's available rates, your financial goals, and how long you plan to keep the property. That's why it's important to compare the total financial picture, not just the interest rate. Let's simplify it. A HELOC may be a good choice if you want ongoing access to funds, you're completing projects over time, and you only want to borrow what you need. A home equity loan may be a good choice if you know exactly how much money you need. You want a predictable payment, and you prefer the stability of a fixed interest rate. A cash-out refinance may be a good choice if the overall financial benefits outweigh replacing your current mortgage. You need a larger amount of cash, or you want to consolidate debt or restructure your financing. There isn't one option that's best for everyone. The right solution depends on your unique financial situation. After helping homeowners for more than 20 years, I've noticed one mistake people make over and over again. They focus only on the interest rate. The lowest rate doesn't always mean it's the best financial decision. Instead, you should consider your monthly payment, closing costs, and total interest over time, your future plans, your cash flow, and how long you'll keep the loan. Sometimes paying slightly more in interest can still improve your overall financial position. if it helps eliminate higher interest debt or better aligns with your long-term goals. That's why every homeowner should have their options compared side by side before making a decision. If you're wondering which option is right for you, I'd be happy to help. I'm Brian Jahambin, and I've spent more than 20 years helping homeowners and real estate investors make informed mortgage decisions. If you'd like a personalized analysis, my team and I can compare a HELOC, a home equity loan, and a cash-out refinance based on your specific financial situation, so you can choose the option that best meets your goals. If you found this video helpful, please like, subscribe, and turn on notifications so you never miss our weekly mortgage and real estate market updates. Leave your questions in the comments below, and I'll do my best to answer them in a future video. Thank you for watching, and I'll see you in the next one.